I hope everybody's doing well. Wanted to go over a little bit of economic data and some trends in the mortgage business. Try not to bore you too much. Just follow along. If you have questions, feel free to ask.
Let me start with the Freddie Mac economic report. It's basically the June outlook, and we'll make this simple. According to Freddie Mac, the growth is slowing down gradually, seems to be coming in line with where the Fed wants things. If you look, the annualized GDP growth is it's close to 2%, which is where they want it. These things are constantly being revised. Quarter one is right here. Looks like there's going to be a little bit of a bump. Housing sales are going to slow because of lack of inventory. I'll touch base on that in a bit. Definitely will try not to nerd you out too much on too much information there. But let's jump to today's bond market. This is over the past 6 months. The 10-year Treasury yield has been coming down some. You see, it's back where it was about February. Reached these levels a couple times for a short period of time. Since then, right around Valentine's Day, if you look at it on a year, I mean, these rates and yields have been a lot worse than where they are now, just in the past year. 5 years out, and you can see we're on top of a plateau. But at all time, I mean, we're still pretty low. I mean, look at that. Um, this is where today is in that chart. So for the majority of the time since the mid 60s, the yield and rates were higher than where they are now. It's pretty interesting information. Now, the reports on Housing Wire and other places like the Federal Reserve Bank of St. Louis are showing a massive reduction in housing starts. Now, if you look, that the new housing permits are tracking for about 1.4 million in builds coming up over the next bit. That's annualized, so that's basically forecasting about that. So I saw another figure about 1.6 through the end of the year. Here's the housing starts from same article where you can see that there's been times back in the 70s where there were more housing starts than now. Uh, there obviously was a huge fall off during that last recession. Borderline depression was in that market. That was a little scary. It's like somebody flipped the switch. These dark lines here are recession periods, but you can see it started well before that. Housing affects so much. So we can see they're slowing. They're low. Historically, they're low. That's as far as housing building and under construction. Now, this is new houses sold by the stage of construction, and this is the not started stage. So it's 83,000 homes were basically pre-sales in April. It's pretty amazing. And then this is showing that trend. So that is just crazy low. Federal Reserve Bank of St. Louis has all kinds of charts on housing starts, median sales prices, a lot of information. If you're in the real estate business or you're just curious about stats, you can find more than you want to know on this. Some of these charts they've only been keeping track of for like a year and a half. So new houses for sale by stage of construction, see they've been going up. There's still only 480,000 units on the market. I mean, that's not a lot in our economy. Already touched on this, touched on that, and these. I mean, and then here's the rates. This is the 30-year conforming average, NFHA. Keep in mind that this is the note rate, not the APR. And these are loans locked through Optimal Blue by the end of the day. So we'll scroll down from 2 years to the past month. You can see these are the averages. If your scores are lower, um, or there's a couple other factors that can affect this. These rates are going to be higher for you if your scores are higher. You have more equity in the house, then these rates could be lower for you. Just for example, so this is a 30-year FHA, right? And one of the questions we get when people ask us about a loan is, why should I do FHA or conforming? Well, that's the 30-year FHA average. Here's the 30-year conforming average. Let's take the FHA out of here because it doesn't give us an option down here on the LTVs and the score. But let's say you're putting 5% down for anything less than 20, the rate's going to be a little bit lower than the average with a great score. And if you have a lower score, the rate's going to be higher. See that? And these numbers here with the lower, less than 80% LTV, that's what's skewing it to make this selection here look higher. See? It's more than 20% down here, 20% or more down. So the rate jumps up a good bit here. I mean, not a ton, but some if you put less money down and have a lower score. Anyway, take care. Talk to you soon.